possible, and a warm thank you to our audience in the room and online. We'd like to make this event as interactive as possible, so you can participate by tweeting about it at @LivePolitico and ask questions through Slido using the hashtag CMUPush. You can see it up there on the screen. Please identify yourself and your organization when you're asking a question. You know who we are. It would be great to know who you are. You can already share your thoughts and answer the following poll, which I believe we can see up on the screen now. What is the main benefit of the non-bank financial sector to the EU economy? It's not rigged. There are people online already answering it, in case you're wondering why we already have some responses. And we'll look back at the results at the end of the panel. So before we get started with the panel, we'll hear some opening remarks from our partner, Gillian Flores, Executive Vice President and Managing Director and Head of Global Government Affairs at the MFA.
Thank you, Catherine, and welcome. It's so lovely to be here on such a beautiful Brussels day, certainly timed well. As mentioned, I'm Jillian. I'm based in Washington, D.C., heading up global government affairs for MFA. MFA is the global trade association representing alternative asset managers, including hedge funds, private credit funds, generally representing the large and globally active participants in that space. Of our nearly 200 manager members, they are highly regulated here in the EU under AIFMD in particular, as well as in other jurisdictions around the world. And alternative asset managers are doing a lot of really important things. They're enhancing capital markets where they're operating, they're empowering the growth of businesses, and they're serving institutional investors who are ultimately trying to provide for their end beneficiaries, such as pensioners. So the conversation also often turns to NBFI, what is it, what isn't it, and where does that sit relative to the banking sector? Our industry is complementary to, but also very different from the banking sector. We don't take depositor money. There is no government backstop or potential for a bailout. There is no liquidity or redemption risk, no asset liability mismatch. And importantly, if a fund fails, the investors of that fund solely bear the loss of it. There's really no risk transmission mechanism to move the issues in a fund to the broader financial system. So today is a really, I think, timely and important opportunity to talk about the EU's economic competitiveness. The Capital Markets Union has the potential to really accelerate growth. The potential, however, will be unmet if policymakers rush to overregulate non-banks in a way that seeks to impose on alternative asset managers and other non-bank participants a bank-like framework. So really excited to hear the thinking of our panelists today on these really timely topics. Alternative asset management, again, provides a lot of benefits to markets: price discovery, a reduction of volatility, making markets more efficient, therefore less costly to even be trading in markets in the first place, and the diversification and risk mitigation that alternative asset managers provide ultimately to investors in their portfolios. Markets with a diversity of participation achieve better outcomes for investors, but also for citizens. And there are a lot of, I think, really timely topics that we can explore more deeply in this space, including securitization or short sale regulation. Also, just the broader, as mentioned by Catherine, conversation around macroprudential tool sets and how they should or should not be applied to the non-banking space. So I am thrilled to hear from our panelists, truly experts in this field. And with that, we'll turn it over to them. Thank you for being here.
Thank you very much, Gillian. So I'm going to get our panelists to come up on stage now. So please give me a warm welcome to Sean Berrigan, Director General at DG FISMA, Natasha Kazanov, Executive Director at ESMA, Stephen Berger, Managing Director and Global Head of Government and Regulatory Policy at Citadel, and Carol Lanu, CEO of the Center for European Policy Studies. Okay, so thank you all so much for being here with us today. I want to kick it off with a very brief question, the same question to all of you. We are in a big moment of institutional change, national change. We've seen EU elections. We've got one institutional mandate ending. We've got a new one beginning. When we're looking at CMU, what's the biggest impact, in your view, that this moment of change will have on the CMU project? I'm going to go to Sean first.
I don't expect too much of a change, quite frankly. I know that's very boring to keep you awake. But I think if you look at the structure of the Parliament, it remains, as the President said on the night, still a very centrist Parliament. And so I don't think the politics in terms of CMU changes that much. More importantly, the demands around CMU, the rationale that is developing for CMU remains the same. So I think it's not a question of radical change in the CMU agenda. I suppose in terms of how we articulate the CMU around the green transition, etc., that may be an area where there will be more discussion. But it's still, I mean, whether or not we need a capital market is really not a function of what the outcome of the European Parliament results are.
Mm-hmm. Natasha, same question.
Yeah, I think it's quite difficult to answer that question, to be honest, but I was going to answer very much along the lines of what Sean was just saying, which is the EU actually needs a capital market union. We need to make that leap. We need to make that change. And so irrespective of what the outcome is, we believe on the ground the needs of our firms, the needs for our investors, that rationale is there. The needs have only been growing, and so we hope the conversation will go in the same direction.
Okay, thank you. Stephen?
In short, I think we see a continued, if not renewed, commitment to achieving the capital markets union. And I think the reforms we've seen over the last few years with respect to clearing, trading, transparency, margin frameworks have put the building blocks for that next phase of integration and deepening of capital markets. Like, we have those building blocks in place now. So I think we're excited at where we see the EU in this juncture.
Carol?
Unlike John, I would say it may be a bit more difficult if you have a more right-wing parliament, not to speak about this extreme right part, to push through things which require more liberalization, more opening up of markets, where you see that some groups which have clearly become stronger in this parliament want less Europe. So it will make it more difficult. On the other hand, if you see the strong impetus behind competitiveness, the Letta report, I mean, it may hopefully have a momentum on its own to really create what we need to create. I just remind you of what was published yesterday by the ECB. Some people will have seen this ECB report. Very well done, very much in depth, but there is a very clear phrase in there, and you see the updated stat on financial market integration. Market integration has been disappointing, even if we have gone through a phase of massive regulation.
Okay, thank you. So, Sean, I want to throw the first question out to you and actually open with a quote from your boss, Mairead McGuinness, from a speech she made yesterday at the ECB. Right. So she said, "We've had really important political declarations, but they are not enough. They have to be matched now by actions. Member states need to set aside the short-term national interest and think European." So from your perspective and from the Commission's perspective, what does it mean to think European, and what are the actions that we need to boost the CMU?
I mean, the way I look at this, and I mean, as I said, the Commissioner is right, she's always right. But she, in this case, absolutely is right, because we have political attention now. So we have European Council conclusions, we have Eurogroup statements, we have a plethora of reports coming in from very important people. That's attention. So they are focused on the issue. But just because you're focused on the issue doesn't make it easier to solve. So all the old complexities, all the old questions are still there. So that attention has to, of course, be combined with political will, and then you have political momentum. So far we have political attention. We have not yet seen what will happen when the rubber hits the road and the ambition for CMU meets the vested interest, as the Commissioner said, which stands against that. Why do I think it matters whether you have European? Well, if you think of the context in which this narrative has changed, the narrative has changed because we're entering, I saw somebody recently refer to it as a Hobbesian world, or a world of competing regional blocks. It's important that Europe's one of those blocks. No member state, no matter how big, is going to be able to compete on that level. Not even the biggest of member states. So really, if we're thinking that that's the world we're heading into, where we're going to compete against blocks, we need to be as big as possible. And that means the solution is, as far as possible and as far as appropriate, European. So that's why I think if the member states are really serious about building a capital market for Europe, then they're going to have to overcome some of the vested interests at national level which have blocked that in the past. Because Carl is right, we had a lot of regulation, but this regulation has not always been exactly as the Commission has proposed it. And that is because vested interests intervene and change it. And if you're not willing to address that, this particular process will continue again, and we'll have exactly the same story again.
And in terms of, I mean, we've seen a lot of different opinions on how exactly that kind of progression and cooperation on CMU could move forward, whether enhanced cooperation could work, whether it has to be all of the EU, whether it could just be the Eurozone countries. I mean, what are your thoughts on this? Does it have to be all or nothing?
I think what's interesting is that if you look at the distribution of the financial services offer, so the provision of financial services, the supply side, let's say, it's concentrated in about 5 or 6 member states. I mean, there's a very large number of member states that have less than 2% of the total market share. So much of it is concentrated. So the action in terms of the supply naturally will happen in these member states. That's where the integration action is probably going to be. But the demand, of course, is 27. So you may want from the supply side to say, oh, let's go ahead with the 5 or 6 and we'll just do it. But you're not doing it for 5 or 6, you have to do it for the 27. So in fact, you can talk about, coalitions of the willing for the supply side, but you can't just ignore the fact that if this market is to work, it will need to service the 27. So the other 22, 21, 20 have a say. And I mean, that is the Commission's view, has always been that this is a 27 project. But I do accept that for many of the 27, the supply side of this market is not particularly relevant. I think, and if you want to see this, we have a table in the withholding tax proposal where we have exempted member states who have less than 1.5% from changing the withholding tax. Not sure why they asked for that, because that keeps them at 1.5%. But okay, they don't have to change their withholding tax. And you drop down to a very small number of member states who are playing. So I think, yes, from the supply side, it's a fairly concentrated game, but from the demand side, it's a full 27.
Carol, I want to bring you in here, because we're talking about the results of this year of change, we're talking about the impact of EU elections. One of the most vocal member states in terms of pushing the CMU agenda has been France. Also, one of the most dramatic results of the EU elections. We're waiting for the result of snap elections now. I mean, what kind of an impact do you think the French political situation might have on the CMU effort as a whole? Are we going to see delays?
France is only, as John was saying, one of the 27 member states, and we will have to move forward. Of course, France could block it, but we've seen that they have made many proposals over the last weeks and months, so I don't see France really hindering this process. The good thing, what we see now, is that France and Germany are in a weak position politically, so it has to come from the EU as a whole. And related to your previous question, I was thinking about this yesterday, 28 regime, which, for example, comes from them, coalition of the willing. What we absolutely need is a more federal, sorry for the word, system. If you think about the United States, when has the United States come forward? When they decided to create a federal securities market regulator and federal securities laws in the 1930s. It took them some time to create an, let's say, a really acting, well-functioning body, another 30 to 40 years, but that's where it is. They have a clear, one single authority in charge, and everything which makes this more complex, which will drive us backwards rather than forwards. So meaning a 28 regime increases complexity. We have to reduce complexity today, which is extremely important. By the way, you could think about Canada, and almost never in this discussion, but Canada has many different local securities regulators, and has been trying to find a way to create a federal securities regulator, because they see this competition from the United States as well. But hardly anybody speaks about Canada here. But Canada has this problem. They want to create it, but of course, like in Europe, they have strong states which want to keep their independence.
Okay, Stephen, I'm going to pick on you as our resident American on the panel. I went to a very interesting conference last week, which had a senior official from a French bank who was talking about the political situation, and he said, internationally, nobody cares about the EU election, that it won't change anything, and that the real event is the US election. I mean, as an American operating in Europe, do you think that the US political direction could affect the CMU and the EU more than the EU's political direction?
I will refrain from speculating on the outcome of the elections in November. I don't know. I guess I don't, I'm not sure I see a direct connection. I think, the degree of dialogue and collaboration across borders can change in different ways based on the outcomes of the US election, but with respect to financial services policy, it's possible that there's just as much dialogue under either administration.
Yeah,
so,
okay.
Yeah, I don't, if anything, perhaps the outcome of the election going in a certain way reinvigorates the EU desire to ensure that it is more independent and competitive with respect to its own capital markets. But at the same time, I think there's a healthy degree of cross-border alignment that's been pursued over the past 5 or 10 years, where there was probably some initial post-financial crisis regulation that sort of led to some initial fragmentation and splintering as divergent approaches were taken. But I do see across the US, the UK, and the EU right now genuine efforts to see what works best, and where appropriate, replicate that, and where not appropriate, look for a different path.
And what do you think is at stake if the EU falls behind in fostering a CMU? I mean, what is the point of a CMU?
Look, I think the more you can deepen and integrate capital markets, I think you have the potential to first and foremost unlock additional sources of capital to foster, economic growth, to foster innovation, to foster greater productivity. And that pays dividends both with respect to, people's day-to-day livelihood and also, the returns they get as they, save for the future. So, I think that's the ultimate goal, to more effectively, deploy capital to drive growth and innovation within the bloc.
Okay, great, thank you. And Natasha, so we're thinking about this moment. ESMA has obviously just had a big publication. Your thoughts on the CMU project. Why enter the conversation now? What do you think ESMA's role should be in this debate? What do you see as your voice?
No, thanks for the question. I think we felt that this was really a moment where it was appropriate to speak up. Normally, as an EU authority, we would leave this to the policymakers, the co-legislators, and there was really this sense of urgency where we felt we need to share the view. And so the paper is really conceived as the perspective of securities supervisors and regulators, so those that are on the ground. It's not an ESMA staff paper, it's endorsed by our board, so the 27 national competent authorities. And even as we have decided, and has been completely understood in my understanding, we have decided to go beyond our usual remit. So we're not talking only about financial regulation there, or our remit in terms of the implementation of those regulations. It goes very broad and tries to provide a comprehensive, a holistic overview of what we think needs to be done so that we can actually succeed in this endeavor. And because, as I said earlier, the urgency is there, we need to mobilize so much private funding to finance the EU goals that cannot be borne by public bodies, public spending, that the budgets are just not able to do that. We really have a duty to make it work. We felt we had to put out there something comprehensive. So it's really designed as sort of 20 different recommendations to support and foster the creation of a well-functioning ecosystem, so that you can have all the pieces. And I would add to the points that Stephen just mentioned on the ultimate goal. I think we also need to bear in mind the need of the EU citizens and investors there. So the idea is that we have well-functioning markets that can then support the needs of our firms so that companies can more easily find the funding they need. Sometimes we're really told they don't find, so maybe to this audience it's interesting, they don't find the capital that they need to grow, and they need to go abroad to get some of that capital, which is not appropriate. We're very happy to be an open market, of course, but it's not right that the firms don't find it at all. And beyond that, we believe that beyond the findings, so the innovation and the growth that goes with it to then develop employment and development of the EU as a whole, we also think EU citizens don't have enough as individuals in terms of their own savings and opportunities. Today, we are concerned with their ability to then have enough to save for their retirement needs. So CMU is also there, and we really want to make sure the investors are at the very heart of the project so that we can deliver good products, cost-efficient, simple products they can understand, and that they can then put their savings to work and benefit from that in the end. So hopefully the ecosystem then can be healthy and sound.
Does anyone want to come back on any of the points that have been raised here? I see you scribbling away, sure.
No, I was listening, taking note of what Natasha said, like a good commission official when we listen to the authorities. No, I was just thinking about this idea of how it links to open strategic autonomy, for example, this phrase that nobody seems to be able to explain. In a sense, it's about options. So I just picked up on this idea of you don't want to be closed, because very often people mistake the CMU project as something to build a closed European market. It's not the intention at all. I mean, I think for firstly, this is a long-term project, so we're not going to be able to close it. We'll still rely on external, but it's not, the intention is to remain open, but to have options. Because today we know that a lot of our innovative companies simply have no choice but to go to New York. It's not that they look at what's available here in Europe and think, maybe I stay here, and then maybe I look at New York and I go to New York. They're not even asking what's available in Europe, because they know it's not there, and they're just flying directly to New York. So it's not that we're going to create a world where there'll be no more going to New York, you have to go to Europe, but we'll create a world in which you will have choices here.
Yeah.
And that's important, because I think there is often a misunderstanding around the CMU project that somehow we're trying to create a sort of protectionist wall around Europe. This is not the case. We're simply trying to create a more, how do I say, secure environment from a typical financial market perspective. We want to diversify. We want options. And so we don't want to be, because for me, this word autonomy, I'm told, and I've said this before many times, doesn't translate well apparently into foreign languages. So it means protectionism, or it means self-reliance. It doesn't translate well into English either, as I've explained, because there's about 100 different definitions of it. But for me, autonomy means not doing something because you have to, but doing things because you want to. And if we have a capital market here and people still want to go to New York because they get a specifically better offer, fine. But they should have a choice. I think that's what's missing today, frankly.
I think you both raise a really interesting point, which is how do we encourage people, citizens, businesses, financial market actors to care about the CMU? I mean, how do we give this project a bit of oomph and get some attention for it? And Karel, I'd like to ask you on this. I mean, how do we get people to care about the CMU when it's this very technical, quite wonky issue?
To help, I would, you say companies, but I think the first thing is you have to try to help policymakers, certainly at the national level, to help them understand what it's about. And that's why I found this title very useful, because it says it's all about creating market finance as compared to bank finance. And even market finance is not well understood, but you need to have, I mean, if you speak about competitiveness, which comes up in your slide, in your Slido, we need to have more competition for provision of services. And if you want to have more competition, that requires more transparency of different actors, more, I mean, a word which many people do not like too much, unbundling, which the Commission is striving with, for example, its retail investment strategy, that there can be competition for the same kind of products between different suppliers, be they banks or non-banks. But today what you see, it's very difficult to enter into this market, the European market probably already, but even more in national markets, because every national market has its different systems, and those which are the incumbents in the market will make it difficult for those which are outside to enter into that market. Basically, it's something very similar to what we've seen in other utilities markets, like in telecoms, like in transport services, energy, and so on, that you have to all of a sudden go in there probably with a big bang, like we did with roaming in the, or say, abolition of roaming in, I think, 2014 in the telecom sector, to really create much more competition. And I remember once in a panel, Mario Nava, a former colleague, was saying this. Probably we'll have to do the same like we did in telecoms, because we need to create more competition between suppliers of, say, different forms of suppliers of similar products, to have it much more transparent for users of these products. And that, I think, is very important. Let's say that, and in this sense, we would create much more liquidity. Because today we have segmented markets, and that's also what the ECB says. Yesterday, I mean, integration has gone backwards rather than gone forwards. And then you wonder why. And that probably we haven't applied the right recipes at the moment. But I think one other thing which we have probably neglected to do over the last years is use DG Comms power. So we need to apply DG Comms powers to, for example, enforce interoperability, which is also something very important, which you know from the telecom sector. In, for example, back offices. I think we have far too many back offices in Europe, which make it far too expensive to get these services. And I think if we were to have more competition in that market, probably we would have better prices, and probably consumers would be more interested to go into that market. Because retail investors, by the way, is a very important segment on that, and they are insufficiently present. I refer to what happened with Musk last week. You see 30% of his investors, retail investors, were not based in the US. Can you imagine a large corporate in Europe which has 30% retail investors not based in Europe, and which are playing a crucial role in deciding on his option or his pay?
Stephen, thoughts?
Just want to build on one of those points, which I think is very important, which is the growth of, if I have to use the term NBFI, the growth of NBFI in all the different stripes that are encompassed by that term is a success story. Like, it's not an anomaly, it's a success story. And it's because these different types of institutions, be they investment funds, asset managers of different stripes, insurers, pensions, et cetera, like, they're offering a value proposition, which is the different investment and capital market services they're providing. So it's not a function of, you know, regulatory arbitrage, and it's not even, I think, supplanting traditional banking activity. It's complementing that and providing choice and competition in terms of fulfilling different financial services and capital markets needs. And you know, the Commission recently, the European Commission recently put out its consultation on macroprudential policies for non-bank financial intermediation, and you know, I of course read it with great interest. But some key points right up front in that consultation I just wanted to note, and I'll paraphrase them, but they open by saying that NBFI is a key source of diversification and resilience in the markets, and that in the context of the CMU, stable and integrated capital markets are a key source of funding for the economy, and they complement traditional bank lending and provide tools to manage risk. So, you know, the report opened by saying that NBFIs and capital markets play a pivotal role in financial market diversity and resilience, and importantly, provide, I think the term they used was private risk sharing, but bringing the private sources of capital to, you know, fund, again, growth, innovation, and competitiveness.
Yeah, Sean and Natasha, I want to come to both of you with this question, because I think we're raising an interesting issue here, which is about the counterbalance between competitiveness and risk. I mean, if you're fostering a CMU, if you're building these integrated markets, what is the appetite for potentially creating more risk? How do we build the CMU while mitigating risk? So, Sean, I'll come to you first. Just what are your thoughts on the risk landscape for NBFIs at the moment?
Well, first of all, I think we have to admit that NBFI is very much a catch-all term. So, I mean, actually it includes insurance as well. So we always need to be a bit more precise on what we're talking about. I suppose what we're talking about here is the fund space, in open-ended and hedge funds, etc. So just the fund space. Let's be a bit more precise. If you think about this, what we did in the 2008-9 crisis follow-up. Unfortunately, some of us were around then and still around now. So, you know, we took a decision to move risk out of the banks, particularly risks linked to illiquidity out of the banks, and it has to go somewhere. So it has gone into the non-bank space, the fund space in particular. So then you see this big growth in the fund space that coincides with the risk or the de-risking of the banking sector. So risk goes somewhere, and as was said earlier, a lot of this risk is in many ways more a recession risk than a financial stability risk. If something happens, a lot of people can lose a lot of money, there can be wealth effects, there can be consumption effects, and therefore we have recessions. But they're not a stability risk. But that being said, there are still parts of that non-bank sector which are linked to the banks, either through direct exposures, and the banks have been increasing their direct exposures to this sector, or indirect exposures. And I think that's the part you have to worry about in terms of financial stability. That if something happens in this space, which we would hope to be a recession risk, turns out because of its links back to the banking system to be a stability risk, then we're back where we were in 2008 and 9. And you don't want the banks to kind of re-risk through another channel when you have de-risked them through this one. And that, I think, is what the concern is. And of course, I still agree what we said in our consultation. We haven't changed our mind in the last few weeks. But it's important that any financial system can do a lot for you in terms of growth and a lot for you in terms of market development if it is stable. But if it is unstable, it does an awful lot of very bad things to you in terms of growth and social cohesion and all of those things. So the focus is moving to growth and competitiveness. This has happened before in the past. It's not wrong. We need to look at growth. But the precondition has to be that the system is fundamentally stable. And then you can talk about what you can do for growth. But if you start taking risks with the stability part in order to push the growth part, we could be on a sort of tricky path here. So my summary is don't cover all NBFI with one brush. Understand what we're talking about. It's not that all risk is a problem in this sector, but some risk can be a problem depending on its link to the banking system.
Natasha, same question.
Yes, I think very similar. First, I want to echo the point that was made both by Stephen and Sean, but we cannot emphasize it enough, that we have this conversation about non-banks or NBFI in a very vague way, which is unhelpful. And it's important, I think, for those who know and who are involved in these discussions to be very clear what are we talking about, and it's a very diverse set of entities and sometimes activities, and what are the specific risks that they pose in each case, and what is the regulation that goes with that. So I think that's very important that we are clear. Then for the success story, absolutely, when you look at the figures, absolutely, the numbers that we have is that the non-bank financial intermediation, so that universe, has more than doubled since the global financial crisis, talking about 42 trillion euros today, which is quite impressive. And similarly, if you just reduce then to just investment management, and you look at what the Farmers published recently, their estimations at end of 23, it was 30 trillion, split between investment funds and mandates. So we're talking big numbers. And so really just to repeat maybe what Sean was saying with other words, but very much agree, we are trying to foster here a sound capital market. So we want to develop a competitive and attractive markets, but the basis needs to be that it is resilient and strong. So we want to make sure that whatever risk is out there is properly addressed, and then on that basis then you can develop. So I would say it's a prerequisite and it complements the CMU project. It does not at all contradict. Then we need to make sure we are balanced and targeted in the risks that we look at, and to see if there's an identified vulnerability, so something obvious. ESMA has been very clear about this. In the money market fund space, we believe that there are some elements we have identified following the Dash for Cash in 2020 that there were some weaknesses there. We think that needs to be fixed. That does not at all come in contradiction to having sound and attractive markets to serve our businesses and foster innovation. So maybe just to make that clear. One point I would add as well, which is similar to what Sean was saying, is this point about interconnectedness. And as much as we've been talking a lot about liquidity and leverage in the fund sector and how we can tackle that, and there are still conversations about how to strengthen that. So on the liquidity, a lot of work is going on. So hopefully we will have a comprehensive framework in the EU with the implementation of the liquidity tools and the different types of funds. On the leverage, we've seen some of the macroprudential type tools starting to be used by some authorities in Ireland and Luxembourg, which are interesting, and we can learn from that experience, whether that is working as intended, where we can reinforce, whether we can do slightly differently or improve. But then also in the interconnectedness point is the question of whether the banks looking at their exposures, do they have the right information? Do they understand their risk? Are they able to risk manage properly their exposure, so that we don't have that connection then in case of a failure or whatever, that hit that comes to an entity, a fund, let's say, not to use the non-banks, I don't like that word, and whether that would then have repercussions within the banking system, and then we have a financial stability issue. So we need still, I think, to do a bit more work on that interconnectedness point,
But again, to say, for me, they really complement each other. As policymakers, we need to make sure we cater both for risks and for a well-functioning market that can support growth.
Yeah. I do want to come back just on one issue that's in the ESMA report on CMU, because one of the points you make is that you don't think competitiveness should be included in ESMA's mandate.
Yeah.
What's the reasoning behind that? I mean, is that a competitiveness and risk in conflict here?
No, so the way we see it is that competitiveness should be a dimension that is looked at in the policy making. And actually, there is a recital that asks us in our founding regulation to consider, but we really think that is much more for the co-legislators, the political bodies, the Commission, to consider the competitiveness impact when they make a proposal. From our perspective as a regulator, we're not convinced that that is something we should look at as a regulator. We have our mandates, and so our focus should be on investor protection, financial stability, orderly functioning markets, stable markets. Then you can consider whether we should have that mandate. We believe that that potentially could come in conflict with those other mandates that we have. And the last point I wanted to make, the way we look at competitiveness as a regulator, again, depending on who is looking at this issue, we believe competitiveness from our perspective could be considered more as an agility point. It would make much more sense for us to consider whether we have the right tools, whether we are agile, and then to support a competitive market, that then we are able to react and be agile in a market that is really developing very fast and there are new technologies coming in. So how can we be equipped in the regulatory community to be effective and agile? That could support competitiveness, but not in our mandate. We believe that that would not be appropriate for our institutional law.
Okay. Would either of you like to come back on this issue, competitiveness versus risk? I mean, do they work together or are they contradictory?
I mean, they should work together. I mean, if, of course, products are well regulated, which, of course, is what Natasha and John were saying. But let me link this to the debate on the long-term savings product, of which I think the proposals are made, and made in a very easy way. Look like we can create it tomorrow. Before you can create something like this, which could be a non-bank or a bank product, mostly a non-bank product, you need to have the design in place that an investor in such a product is adequately protected. And this is not so easily done. And of course, one of the reasons that, for example, the previous discussion on this personal European pension product didn't work well, because some member states, but also groups, industry groups, thought it would interfere with what existed at national level. Mm-hmm. And in the meantime, we have a PEP which have created, which, is suboptimal, which because of legislators have designed it in a way that today only one PEP exists, or one provider of a PEP exists. And that is extremely important, let's say. So if you then speak about a non-bank, an NBFI product, the design of such a product has to be thought through very well, but also the supervision of such a product has to be done well. Because if you were to invest in such a product and you lose, like, for example, I mentioned this example of Austria, if you were to have invested in a form of a third pillar pension product in Austria, in 2022, they lost 20%. Mm-hmm. If you once lose 20% in such a product, you say, I never do it again. So it is extremely important, if we take these proposals forward, that the designs are well done. Of course, we need to create a large-scale product, because the larger the scale, the better you can diversify and the better you can guarantee, let's say, a reasonable good returns. But of course, the supervision, the regulation and the supervision will have to be very well done.
I want to bring in a question from the audience here, because it's to do with the point you were making. So, anonymous question, unfortunately, but I imagine this is aimed at Natasha and Sean. How can the Commission and the ESAs agree on the direction of non-bank supervision when their opinions are so divided, like on the implementation of rules on LTIFs?
Well, I will answer that by also picking up on this competitiveness risk. So I won't avoid the question, believe me, I will come to it. But it's actually quite related, because I think there is no problem having a competitive risk trade-off. I mean, that is something that we all have to do. It's where it fits in the institutional framework. Now, this has come up, of course, because in the UK, there was this decision to include competitiveness as an element in the mandate of the authorities. But they don't have a commission. They don't do it by they don't legislate by co-legislation. So in a sense, it probably makes more sense that Natasha and her team give us the supervisory view, and we allow the co-legislators to balance that supervisory view with the other view. And then, of course, the only thing that has to be done is that the level 2 reflects the balance that's struck in the co-legislation. So if the co-legislators move the balance more from supervision to growth, that has to be reflected not just in level 1, but all the way down. Which brings me to the second point. We don't always have to agree with ESMA either at level 1 or at level 2. In level 1 in IOPA, they sent us 1,000 pages of supervisory input on Solvency II. We took a lot of it, but we didn't take it all. And then the co-legislators moved us even further away from where IOPA was. So this is a co-legislative discussion. We will always make sure that whatever is agreed at level 2, in our view, coincides with the level 1 balance. And of course, that's always a matter of judgment. And I think ESMA judges that what they have put is in favor. We don't believe so. It's not a fundamental disagreement. It's about how you align what is coming out at level 2, as we perceive to be the balance struck level 1. So it's not that we kind of fundamentally disagree and we're going to think that things are radically different. It's that balance we have to keep. Because if we agree something at level 1 and then the level 2 can just go back to where they were before, then we probably will have to put competitiveness in the mandate of the authorities. But that's the way it works.
Yeah.
They give us a supervisory view, we agree level 1, we ensure level 2 looks like level 1.
Natasha, any thoughts here?
Yeah, just to share that maybe, LTIF is maybe very obvious because it ended up in the public domain, because when we disagree, it ends up in the public domain, but what you don't see is that we most of the time agree, actually, on especially on this issue that we are being asked. We discuss a lot with the Commission and with our colleagues on what should be done in this area, and there's a lot of alignment. The concern is we are looking at risks, so when we look at risks, generally we align. And here it's really a question of how do you look at a situation from our perspective, from a risk assessment perspective, we were concerned. And as Sean was reminding, from an institutional perspective, they are the guarantors of the respect of what was the political agreement on this text. And they felt that we were asking them to go too far. From a risk perspective, our board continued to feel that that was asking them too much, and so we ended up in a disagreement. But for me, that is very healthy, that that conversation can be aired, and that you can identify the areas, and then the legislators knowingly say, okay, we believe that that is the decision, and we believe we should go there. And it's our duty, I find, as supervisors to say, we are concerned with the liquidity mismatch in this area. But again, in most areas, we actually agree.
We have another question from the audience on insurance. I'm going to open this up to whoever wants to answer it because it's not directed to anyone. How is the current revision of Solvency II supposed to encourage insurance companies to foster the CMU? Anyone want to take that one?
I suppose it's going to be me. Well, as I said, when we put solvency on the table, first of all, we had received quite a lot of advice from the supervisor. We rebalanced that advice to move in the direction of market development and growth. So basically, we wanted to release capital, but we had a proposal which was to release it now and then gradually sort of take it back over time. In the co-legislation process, another outcome came in the Parliament, and the Council went for a much bigger release of capital and less taking back. So that is how it's working. I mean, the Solvency II proposal, as agreed in co-legislation, releases quite an amount of capital back into the system. That capital will be invested. Hopefully it will be invested in capital markets appropriately. We know that the insurance have very large balance sheets. They are potentially very big players in capital markets. But again, you have to make those markets attractive. And if you speak to an insurer, the securitization discussion is very interesting. Everybody believes we should have securitization and lots of it. But if you talk to an insurer, they don't necessarily want to buy it because it's complicated for them. There's a lot of due diligence involved, and the yields are not very high. Perhaps when the yields pick up, but what I said, we can't force the insurance industry to build CMU. We can simply help it to release capital. But on the other hand, then we have to make the CMU process attractive for these guys to invest in that.
Okay, we're almost coming to the end of our time slot. I'll take one more audience question on Slido. Again, not directed at anyone, but I imagine this is one for Stephen. How can industry boost participation, presumably in capital markets, when it lobbied against measures for consumer protection, like the inducements ban or the real-time consolidated tape? Anyone want to take that one, Stephen?
So, as one of the fiercest advocates for the real-time consolidated tape, I guess I'm not, I'll take the other side of that. Like, that's an initiative that we think is going to be a very positive development for the EU capital markets. We look forward to the introduction of real-time post-trade consolidated tapes for both the bond and derivatives markets as well as for the stock markets. So anyway, I guess I object to the characterization because I do think that there are certainly diversity of opinions on some of these topics within, financial markets, but I don't know. I know which ones I've lobbied for, and many in the industry have. So, also, sorry, one other point I just want to pick up on that I think is important. I don't think there's a trade-off between financial stability and resiliency and competitiveness. I do think they, in fact, can be quite complementary. I think markets that are stable and resilient are more attractive for investors to commit capital in, and investor confidence, by extension, helps people stay in markets even during times of volatility. And if I look at a reform like central clearing, I think that achieved both. It added to the stability and resilience of markets. It created predictable default management frameworks. So when a company's in trouble, I have confidence that if they fail, we'll be able to resolve that portfolio in a way that mitigates that collateral damage through interconnectedness, because I know how that's going to play out. But at the same time, central clearing also puts a market on a more level competitive playing field where anybody can trade with anybody else in the marketplace, and that in turn can foster greater competitiveness. So I think there are many examples of how those objectives are actually complementary, not contradictory.
Sean, did you want to say something here very quickly?
I just wanted to come back on this investor protection point and the retail. I mean, there's a lot of convergence in all of these inputs we're getting, including ESMA's input. I should have mentioned your input when I listed all the other ones. A lot of convergence around what should be in this capital market union project or whatever. But for me, if you think of the most important thing, it is indeed retail participation. If you don't have a demand side to this market, then there's not going to be a market. It's a bit of a truism, no? And we don't have an adequate level of retail participation. And I'm not sure that what we have on the table today as the retail investment strategy coming out of the co-legislation is going to do that. And if we don't boost that number from where it is today, that is not going to work.
You've already anticipated my last question, in fact,
Good.
which was, so I'm going to skip you and go to the other panelists and just ask, CMU, how do we get there? What is the most important thing to make sure we achieve it in one sentence? Karel, I'll come to you first.
We need to have, easy to say, more powers for ESMA or for a central securities market regulator, which comes out much more strongly against eventually national monopolies, but above all to ensure adequate investor protection all over the EU.
Stephen, same question.
For me, it's seeing greater integration of the infrastructure and plumbing across the EU, be that with respect to trading venues, clearing venues, transparency frameworks, et cetera. So that brings everybody into sort of the same liquidity pool in a more efficient way that fosters growth.
Natasha, you have the last word.
Yeah, so as I said, we see it as an ecosystem and we need multiple pieces. But what was not just said, I would mention two things. I would mention we need that long-term patient capital in our market, and that requires member state and national measures to create tax incentives, pension reform, so that participation can come. And the second element is the equity culture that we haven't discussed. But if you want to foster innovation growth, then you need to shift to an equity culture, and that comes with financial education, different market participation. So that also is something we really need to bring into our market, which is not yet there in the EU.
Well, thank you very much to all of our panelists. Before we close, we're going to have a quick look at the final results from our poll. I believe I have it here. I need to put in an answer to be able to see the results. Okay, right. What is the main benefit of the non-bank financial sector to the EU economy? You can see the results up here. Fostering competitiveness and economic growth is racing ahead with 49%, followed by access to more tailored funding solutions for businesses, greater portfolio diversification for investors, and financing sustainability transition initiatives. So thank you very much to everyone who weighed in there. And finally, I would like to just thank our speakers for joining us, to you, the audience, for following us and following us online as well in the room. And finally, to our partner, the MFA, for making this event possible. We're always happy to hear your feedback, so if you want to contact the events team with your tips, tales, and traumas, please contact them at live@politico.eu. And you can always check our Politico events website for the latest lineup on all of our events happening this year. You don't want to miss our Competitive Europe Week, which is starting on October the 1st. So all that remains is to say a big thank you to our panelists.
United in diversity. We are very heterogeneous in our opinion.
If we do not renew our partnerships with the rest of the world, Europe will not be relevant.
We can make it if we are together as Europeans.
Do you genuinely believe that countries will manage to reach these very ambitious targets?